Good day, everyone. Welcome to another video lecture for Intermediate Accounting 3. I am your instructor, Ms. Jazelme Celerinos Del Monte. In my previous video, you were enlightened on the equity-settled type of a share-based compensation, or the share options. Now, in this video, I will discuss the cash-settled type of a share-based compensation, particularly the share appreciation rights. But before we proceed to a detailed share appreciation right, let us recall first the concept of a share-based compensation. So a share-based compensation is an additional compensation granted to company officials, management personnel, employees, and other stakeholders with or without conditions. The compensation given may be in the form of an equity instrument or cash, which values are measured on the basis of the fair value of the equity instrument. So what is a share appreciation right? A share appreciation right entitles an employee to receive cash which is equal to the excess of the market value of the entity's share over a predetermined price for a stated number of shares. In a share appreciation right, employees will receive such compensation as the prices of the shares increase. Otherwise, no compensation will be given. That is the essence of a share appreciation right. Unlike the share options, share appreciation right creates a liability for the entity on the date of grant, since the entity already has a present obligation to settle or pay cash to the employees once the rights are exercised. Now, how to measure the compensation in relation to share appreciation right? The compensation expense shall be measured at the fair value of the liability. Such compensation shall be remeasured every reporting date until it is finally settled. And any changes in the fair value of the liability shall be reported in the profit or loss. How is the fair value of the liability computed? Fair value of the liability is equal to the excess of market value of shares over a predetermined price for a given number of shares over the vesting or a definite vesting period. We must put into note that the market value should be higher than the predetermined price so that there is a share appreciation. Otherwise, no liability shall be recognized. The final cash settlement will only be determined upon the exercise of the share appreciation rights and not on the date it is granted. When is the compensation recognized? It matters if the right is vested immediately or not. If the share appreciation right vests immediately, the compensation is recognized immediately on the date of grant. If the share appreciation right does not vest until the employee completes a definite vesting period, the compensation is recognized over the service or vesting period. So now let's have an illustration for a share appreciation right. An entity granted a share appreciation right to the general manager on January 1, 2019. After a 4-year service period, the employee is entitled to receive cash equal to the appreciation in share price over the market value on January 1, 2019. Thus, the market value on January 1, 2019 is the predetermined price for purposes of determining the compensation. The share appreciation right had the following terms. Number 1, service period, which is from January 1, 2019 to December 31, 2022, which is actually a 4-year vesting period. Number of shares to be distributed or to be given will be 20,000 shares. Exercise date is on January 1, 2023. The quoted price of the entity's shares are, for January 1, 2019, we have 200. December 31, 2019, 210. December 31, 2020, 220. December 31, 2021, 240, and December 31, 2022, 250. Let us determine the amount of compensation recognized on each significant dates and the necessary entries to record the transactions. First, on the date of grant, there will be no compensation and liability to be recognized as the right is vested after a 4-year of service. Thus, compensation shall be recognized over the vesting period. At the end of 2019, the amount to be recognized is 50,000, computed as follows. For the market value on December 31, 2019, which is 210, less the predetermined price on January 1, 2019 of 200, the excess is 10 pesos per share, multiplied by the number of shares of 20,000 shares. Thus, the estimated fair value of the compensation at the end of the vesting period is 200,000. Now, we are going to get the first year of the vesting period. Therefore, we divide it by 4. Thus, the compensation for 2019 is 50,000. To record the compensation, debit salaries expense 50,000 and credit accrued salaries payable 50,000. At the end of 2022, the amount to be recognized is 150,000, computed as follows. Market value on that date is 220, less the predetermined price of 200, the excess, which will be the fair value of the shares, or the liability, 20 pesos times the number of shares, 20,000. Thus, the estimated compensation or fair value of the compensation at the end of the vesting period is 400,000. Now, since we are on the second year of the vesting period, the accrued compensation as of the second year is 200,000. But previously, on the year 2019, we have recognized 50,000. Thus, the compensation expense for the 2020 current year alone is 150,000. To record, debit salaries expense 150,000 and credit accrued salaries payable 150,000. On the 2021, the third year of the vesting period, 400,000 shall be recognized as compensation, computed as market value on 2021 is 240, less the predetermined price of 200, thus the excess is 40, multiplied by the number of shares, 20,000. The estimated fair value of the compensation at the end of the vesting period is 800,000. To get the accrued compensation as of the third year, we'll just use the fraction 3/4 or 3/4 since we are on the third period. So 800,000 times 3 divided by 4 years, we have 600,000. To get the current compensation expense for 2021, we have to deduct the accrued expense or accrued compensation as of the second year, 2020, which is 200,000. Therefore, the current compensation expense for 2021 is 400,000. So to record, debit salaries expense 400,000, credit accrued salaries payable 400,000. For the last year of the vesting period, December 31, 2022, the amount to be recognized as compensation is 400,000, computed as market value on December 31, 2022, 250, less the predetermined price, 200, the excess is 50, multiplied by the number of shares, 20,000, thus the accrued compensation on the last year of the vesting period, 2022, is 1 million, less the accrued compensation as of the third year of the vesting period, which is 2021, 600,000. Therefore, the current compensation expense for the year 2022 is 400,000. To record, debit salaries expense 400,000, credit accrued salaries payable 400,000. On January 1, 2023, the settlement date, Assuming all the rights are exercised, the total liability of 1 million as of the end of the vesting period shall be closed once settled. So entry, debit accrued salaries payable 1 million and credit cash 1 million. Now let's have another assumption. Suppose that on the last reporting date of the vesting period, December 31, 2022, the market value of the shares drops from 240 into 210. In effect of the decrease, there was no appreciation occurred during the period. In this case, a decrease in the liability and a gain on reversal of share appreciation rights must be recognized. Let's say the market value on December 31, 2022 is 210 and the predetermined price is 200. Then the excess is 10. Multiplied by the number of shares, the fair value of the liability on the said date is 200,000 pesos. Since the previous year's balance is 600,000, a decrease in the liability of 400,000 shall be recognized. To record, debit, accrued salaries payable, 400,000, and credit, gain on reversal of share appreciation rights, 400,000. If you notice, there is still a liability reported even if the market value has dropped. That is because the decrease has not yet reached the predetermined price. Now let's take a look into this another assumption. Suppose in the preceding illustration, the market value of the share unfortunately drops to 200 on December 31, 2022. Since the predetermined price is also 200, the entity has no more obligation because there is no appreciation or increase in the market value on the exercise date. In this case, the accrued compensation on December 31, 2021 of 600,000 shall be reversed on December 31, 2022 in full amount as follows. So debit, accrued salaries payable, 600,000, and credit, gain on reversal of share appreciation rights. Now let's have another illustration. On January 1, 2019, Module Company granted 100 share appreciation rights to each of the 500 employees on condition that the employees remain in the employ of the entity during the 3-year vesting period. The employees exercised their share appreciation rights as follows. December 31, 2021, 100 employees. December 31, 2022, 250 employees. December 31, 2023, 150 employees. The fair value and intrinsic value of the share appreciation right are as follows. December 31, 2019, 15, the fair value. December 31, 2020, the fair value is 18. December 31, 2021, the fair value is 20 and intrinsic value is 15. December 31, 2022, fair value is 21 and intrinsic value is 20. And for December 31, 2023, the intrinsic value is 25. The intrinsic value of the share appreciation on the date of exercise is the amount paid to the employees. The problem has a unique scenario as the rights are gradually exercised every year after the vesting period. Now let's compute the amount of compensation and the liability to be recognized and the necessary entries to record the transactions. Still, on the date of grant, there will be no compensation and liability to be recognized as the right is vested after a specific vesting period, and that is a 3-year vesting period. Thus, the compensation shall be recognized over the vesting period. At the end of 2019, the amount to be recognized is 250,000, computed as follows. Share appreciation rights for the employees. We have 500 employees at 100 shares per employee. So we have 50,000 shares multiplied by the fair value, 15 Therefore, the estimated total fair value of the compensation at the end of the vesting period is 750,000. If you notice, the fair value is already given, meaning this is already the difference between the market value and the predetermined price, the 15 pesos. Again, the estimated total fair value of the compensation and the liability at the end of the vesting period is 750,000. But since we are still on the first year of the vesting period is 3 years, so we have to get the current liability and compensation for the first period or the first year of the vesting period. So we divide it by 3. Thus, the compensation and liability on December 31, 2019 is 250. To record salaries, 250,000 and credit accrued salaries payable, 250,000. At the end of 2020, the amount to be recognized is 350,000 computed as share appreciation rights, 50,000, multiplied by the fair value on that date, 18. So the estimated total fair value of the liability after the vesting period is 900,000. And since we are still on the second year of the vesting period, we will get the balance after the second year or on the second year, which is 600,000. That is computed as 900,000 times 2/3. Okay, so 600,000 less the accrued liability as of December 31, 2019 of 250,000 to get the current compensation or the adjustment for the year 2020. That is 350,000. So to record, debit salaries expense 350 and credit accrued salaries payable 350,000. For the last year of the vesting period, the year 2021, portion of the share appreciation rights have already been exercised and portion will left unexercised. Okay, so what will happen? So in this case, there will be 2 kinds of compensation to be recognized. Compensation in relation to the rights not yet exercised and compensation in relation to the rights exercised. So in this portion, we are going to compute the compensation in relation to the rights not yet exercised. So the amount to be recognized as compensation in relation to the rights not yet exercised is 200,000. Computed as share appreciation rights not yet exercised. So there were 100 employees exercised. Therefore, 400 employees left wherein their rights are not yet exercised. So 400 employees times 100 shares per employee. So we have 40,000 shares. Multiply by the fair value on that date, 20. Therefore, the accrued liability as of December 31, 2021 is 800,000. Take note, when we say accrued liability, that pertains to the rights not yet exercised. If those rights were already exercised, then that will not form part in the accrued liability. So again, the accrued liability on December 31, 2021 is 800,000. Less the accrued liability on December 31, 2020, which is 600,000. Therefore, the compensation expense for the current year 2021 in relation to the rights not yet exercised is 200,000. To record, debit salaries 200,000 and credit accrued salaries payable 200,000. For the compensation in relation to the rights exercised, we will recognize 150,000, computed as the number of share appreciation rights exercised is 10,000. That is, for 100 employees times 100 shares per employee, times the intrinsic value. Okay, so at this point, we were using the intrinsic value because this is already the settlement. Settlement for the rights already exercised. And as we mentioned in the problem, intrinsic value represents the amount paid to those employees exercising the rights. So times 15, we have 150,000. Please take note, class, it is not accrued liability, but instead, it is the amount paid to the employees. Okay, so kindly disregard the accrued liability. So again, cash settlement for that particular period is 150,000. So to record, debit salaries 150,000 and credit cash 150,000. So if you will be asked how much is the compensation reported on the year 2021, that would be 350,000, composing the compensation in relation to the rights not yet exercised of 200,000 and compensation in relation to the rights exercised 150,000 for a total of 350,000. But for that 350,000, there's only a 200,000 accrued liability. Okay, for the year 2021. 200,000 lang because again, those were related to the rights not yet exercised. For the year 2022, how much will be the compensation to be recognized? Again, on that year, there were still rights that were not yet exercised and portion also are already exercised. Again, the total compensation to be reported on that year will compose the compensation in relation to the rights not yet exercised and the rights already exercised. So now let's identify how much will be the adjustment or the recognition for the compensation in relation to the rights not yet exercised. So we have share appreciation rights not yet exercised as of December 31, 2022. We have 15,000 shares. How did we get the 15,000 shares? At the end of 2021, there were already 400 employees na wala pa nag-exercise sa rights, less 250 employees who exercised their rights. So meaning, there were still 150 employees who were not able to exercise their rights yet. So 150 employees times 100, that is 15,000 times the fair value of the rights on that date, 21. So the accrued liability, the must be balance of the accrued liability at the end of December 31, 2022 is 315,000. So now how much will be the amount to be recognized as accrued liability for the current year 2022? Is there a need for an increase in the liability or a decrease? Now, let's take a look on the accrued liability from the previous year, 2021. So, last year, sa 2021, our accrued liability balance is 800,000. But this year, 2022, we must only have a liability of 315,000. Thus, there must be a decrease in the accrued liability. So, decrease in the accrued liability is in the amount of 485,000. So, how do we recognize the decrease? Once there's a decrease in accrued liability, we need to adjust also our compensation. So, our compensation should also have a decrease by 485,000. So, to record, debit accrued salaries payable and credit salaries payable for 485,000. And to record the compensation in relation to the rights exercised, we have 250 employees who exercise their rights times 100 rights. So we have 25,000 rights all in all. Multiply by the intrinsic value or the amount paid per right exercise, we have 20. So the total payment for the year 2022 is 500,000. So entry to record the payment is debit, salaries expense 500,000 and credit cash 500,000. Now, how much will be the compensation expense to be reported for the year 2022? So again, the compensation expense to be reported for the year composed of the compensation in relation to the rights not yet exercised and compensation in relation to the rights exercised. For the rights not yet exercised, since there is a reversal of accrued liability, so may reversal din sa compensation. So, decrease in the compensation by 485,000. And for the compensation paid in relation to the rights exercised, 500,000. Thus, there is a net compensation expense for 2022 in the amount of 15,000. For the last year, December 31, 2023, the last and the final settlement, we have share appreciation rights exercised, 150 employees. So, 150 employees na lang ang natira. Times 100, so we have 15,000. Multiplied by the intrinsic value, 25. So, total payment made in 2023 is 375,000. Less the accrued liability on December 31, 2020. So, we have 315,000. The net compensation expense for 2023 is 60,000. So, in this case, we are already closing the accrued salaries payable. It is because this is the final settlement, meaning as of the date, as of the end of 2022, there are no more rights that are not exercised because all rights were exercised. So, i-close natin yung accrued liability. And the net will be the compensation expense to be reported. So, the total cash payment is 375. While the net compensation expense is 60,000. So, to record, debit salaries, 60,000. Debit accrued salaries payable to close the account, 315,000. And credit cash, 375,000. So, that is for the situation wherein the rights were gradually exercised. Now, in some situations, the entity may grant a share-based compensation, but the form of settlement is not yet definite. In that case, alternatives may be provided. This can be either cash or share alternatives. For cash alternative, of course, cash payment equals the total market value of a certain number of shares subject to certain conditions. On the other hand, share alternative is the equity shares given to the employees. The accounting procedures for this type of instrument depends on which party has the choice of settlement. If the discretion lies to the entity, the instrument shall be accounted initially as either a liability or equity, but not both. The entity will choose if it will account the instrument as liability or equity. However, if the choice is given to the entitled employees, the instrument shall be accounted as a compound instrument. Thus, a liability for the cash settlement or cash alternative and an equity for the share alternative will be recognized separately. In a compound financial instrument, the fair value of the liability shall be determined first, and any residual value of the compound financial instrument after deducting the fair value of the liability shall be the equity's measurement. So now let's have the illustration for cash and share alternatives. On January 1, 2014, an entity granted to an employee the right to choose either 20,000 shares for share alternative and cash payment equal to the market value of 10,000 phantom shares for cash alternative. So when you say phantom shares, this will be the basis for the computation of a cash alternative share-based or share appreciation right. The grant is conditional upon the completion of 3 years of service. If the employee chooses the share alternative, the share must be held for 3 years after the vesting period. The par value of the share is 25 and the grant date on January 1, 2014, the share price is 51. The share prices of the 3-year vesting period are 54 on December 31, 2014, 60 on December 31, 2015, and 65 on December 31, 2016. After taking into account the effects of post-vesting restrictions, the entity has estimated that the fair value of the share alternative is 48 per share. PFRS 2 paragraph 38 requires that this compound financial instrument shall be accounted for separately as liability and equity. Why? It is because the employee entitled with this kind of compensation has the right to choose whether a cash alternative ba or share alternative. Let's identify the fair values of each financial instrument composed in this kind of compensation. The fair value of the share alternative, 576,000. That is 12,000 shares times 48, less the fair value of the liability on the date of grant, which is 510. Again, we have to determine first the value of the liability, and the residual value of the fair value of the share alternative after deducting the fair value of the liability will be the equity component. So the equity component is 66,000. The fair value of the share alternative of 576,000 is actually the fair value of the whole compound financial instrument. Now, for the year 2014, December 31, 2014, we need to determine, or we need to identify the compensation to be recognized. And the compensation here will reflect two kinds of instrument, the equity component and the liability component. For the equity component, the amount to be recognized as compensation is 22,000. That is 66,000, which is the total value of the equity component divided by the 3-year vesting period. So every year, we will recognize 22,000. So entry, debit salaries for 22,000 and credit share options outstanding 22,000. For the liability component, that would be 180,000 computed as the share basis, which is the phantom shares of 10,000 times the fair value of each share on that date, 54. So the total liability or the estimated liability at the end of the vesting period is 540,000. And since we are still on the first year of the vesting period, we divide it by 3. So the accrued liability as of December 31, 2014 is 180,000. And that also will be the amount to be recognized as the compensation. So to record, debit salaries 180,000 and credit accrued salaries payable 180,000. For the second year of the vesting period, still, the amount to be recognized as compensation in relation to the equity component is 22,000. So entry, debit, salaries, 22,000 and credit, share options outstanding, 22,000. For the compensation in relation to the financial liability, that will be 220,000, computed as the share basis of 10,000 times the market value of the shares on that date, 60. So the estimated total liability at the end of the vesting period is 600,000. But since we are still on the second year, so we will prorate to get the second year's estimated balance. So that is 2/3. So the total liability times 2/3, that is 400,000. So this is the balance of the accrued liability at the end of December 31, 2015. Now, to get the compensation for the 2015 year alone, so i-minus nato ang accrued liability on December 31, 2014 balance of 180,000. Thus, we have 220,000. So, entry to record, debit, salaries, 220,000, and credit, accrued salaries payable, 220,000. For the last year of the vesting period, still we are going to recognize a compensation in relation to the equity component. So, entry, debit, salaries, 22,000, and credit, share options outstanding, 22,000. For the compensation in relation to the financial liability, the amount to be recognized is 250,000 computed as share basis 10,000 multiply by the market value on December 31, 2016, we have 65. So the estimated or the accrued liability balance for December 31, 2016 is 650,000. Less the cumulative balance of accrued liability as of December 31, 2015, that is 400,000. Therefore, the compensation for 2016 and the amount of adjustment for the accrued salaries payable is 250,000. So entry, debit salaries 250,000 and credit accrued salaries payable 250,000. So final accounting. The method of settlement chosen by the employee will determine the final accounting. So first, if the employee has chosen the cash alternative, the journal entry on December 31, 2020 will be debit accrued salaries payable 650,000. So this one is the balance of the accrued salaries payable as of December 31, 2016. So upon settlement, we'll just close the account. So we debit accrued salaries payable 650,000, and at the same time we will close also the share option outstanding with a balance of 66,000. And credit the cash representing the amount payment or the cash settlement to the employee. So that is 650,000 computed as, of course, number of shares, 10,000 shares times the market value of each share, 65. So total of 650,000. And the share options outstanding will be close to share premium. So 66,000. So this is the entry if the employee chose cash alternative. Now, if the employee has chosen the equity alternative, the journal entry on December 31, 2016 will be first, i-close ang accrued salaries payable and share options outstanding by debiting this account with similar amount. And we will credit share capital equal to the par value of the shares issued. The number of shares issued on an equity alternative is 12,000 times the par value of 25. So we have a share capital of 300,000. And balancing figure, the balance will be credited to share premium. So the share premium amount credited is 416,000. Take note that we used in this alternative the number of shares of 12,000 and not the 10,000 phantom shares, again because the employee chose the equity alternative. So let's have another illustration. On January 1, 2014, an entity purchased an equipment for 5 million. The supplier can choose how the purchase is to be settled. The choices are 50,000 shares with par value of 50 in 1 year's time, or cash payment equal to the market value of 40,000 phantom shares on December 31, 2014. At the grant date on January 1, 2014, the market value or the market price of each share is 110. Now, similar with the previous illustration, this illustration states that the supplier or the receiver may choose how to settle the purchase. So, it could be a cash settled or an equity settled. Therefore, this instrument shall be accounted as a compound financial instrument. So, there will be two components, a liability and an equity instrument. Now, if the fair value of the asset received can be measured directly and easily, as in this case, the equipment component is the fair value of the asset minus the fair value of the liability. Again, as a recall, when there is a compound financial instrument, we will determine first the fair value of the liability. And any residual from the fair value of the compound instrument after deducting the fair value of the liability shall be the equity component. So the fair value of the equipment will become the fair value of the compound instrument, 5 million, less the fair value of the liability, which is 4.4 million. Thus, the equity component is 600,000. So, to record this one on the date of purchase, debit equipment, 5 million, credit accounts payable, 4,400,000, and credit share options outstanding, which represents the equity component at 600,000. If the fair value of the asset received cannot be measured directly, the asset recorded at the fair value of the shares to be issued, or the asset is recorded at the fair value of the shares to be issued. Again, if the fair value of the asset now is not reliable, then we will use the fair value of the shares to be issued as the value of the asset and will become the value of the compound instrument. In such a case, the fair value of the equity component is the fair value of the shares to be issued minus the fair value of the liability. So to record the settlement, assuming the supplier has chosen the cash alternative and market price of the share is 130 on December 31, 2014, which is 1 year after the transaction, the entry will be debit accounts payable 4,400,000, debit share options outstanding 600,000. So what we did was to close the account, the liability account, and the equity component account. And another debit is interest expense of 800,000. Credit cash equal to the cash settlement 5,200,000, and credit share premium for the closing of the share options outstanding 600,000. So interest expense there represents the implied interest. Okay, so since we paid for 5,200,000, but the fair value of our liability on the date of transaction on January 1, 2014 is only 400 or 4,400,000. Therefore, there is an implied interest. And that implied interest will be recognized in the profit or loss as interest expense. Now, to record the settlement, assuming the supplier has chosen the share alternative, then of course there will be no more interest expense and there is no cash settlement. Therefore, we will credit a share capital equal to the par value of the shares issued. So again, we will just close the liability and the equity component with similar amount, and we will credit share capital at 2.5 million. That is 50,000 shares times 50 par value, and credit the balancing figure into a share premium in the amount of 2,500,000. So that's the end of this video lecture. For more knowledge, you may also refer to these sources to help you further understand the lesson. If you like this video, please give a thumbs up and subscribe to this channel for our future video lectures. Till our next lesson class, bye!